All right, we'll get started here momentarily. Thanks everybody for tuning in today. We've got a interesting topic that is always top of mind these days. Where are mortgage interest rates going? What can we do with them now? What can we do with them later? What does it mean to the future of the real estate market? We've got a guest on tap here, but I'll introduce myself. I'm the associate broker team lead at My Home Connection. Do want to introduce Chase Hodgson with Summit Funding. How you doing today, Chase?
Fantastic, Jerod. Good to see you, my friend.
Yeah, good to see you, man. I always appreciate you coming on the show and sharing your wisdom on the lending side, sharing with everybody the ins and
Wisdom,
outs, the pros and the cons, the ups and downs, or how whatever terminology you want to use.
wisdom. That makes me feel old today for some reason.
That's funny, wisdom. Yeah, they usually correlate to age, don't they?
Uh, yeah,
uh,
context.
yeah, well, I just wanted to, kind of chat about, what are the things to think about? I know the first thought is, oh, and by the way, before we get into the interest rates, we do actually. Sorry, let me back up a little bit just to capture a tool we've got for you, sponsored by today by the Perfect Home Buying Process. We do have a five-step process that has been developed over the last couple of decades in regards to making your home buying process that much more smooth and efficient. We've got a number of tools that we've developed in the way of a weekly podcast series to answer as many of the questions or all the questions that you might have about buying a home. We've even started in a lifestyle series about things to do in the Treasure Valley or the Boise, Idaho area, market reports, school reports, neighborhood reports, and also some insight into some real estate secrets that'll be very helpful for you to know about in that process. And we'll share with you a little bit later on how to take advantage of all these the tools and offers that we have here for you. But back to the conversation around what the first thought is typically: rates are higher, bummer, I'm going to wait.
Oh, yeah.
Good, perfect response. Tell us why that is, Chase. Why that's a bad response.
It's not always right. So it's situational, right? It really is. But that immediate response is not good because you don't know what the situation is. In our market, and always have to preface these kind of conversations with, we don't have a crystal ball, and all we can do is use the information in the historic numbers and the current data that we have. I have a degree in economics, and I'm not bragging. I'm doing that because all through school, it's guessing, right? Like, it's forecasting. Economics is forecasting. And so you take all the information and you put it in there and you come out with the best result, the closest result that you think. And a lot of factors that can go into that in the meantime and change the outcome.
Mm-hmm.
And so that's why I want to preface that, is because you really need to look at everything that's going on right now. And I think, yes, rates are higher. A lot of people won't qualify. And I can't remember the exact number, right? But if rates, because we're not there anymore, but we hit like national average a couple weeks back of 8%, and you would have thought the world was gonna, come
Come
apart
to
at
an
that
end.
point.
Yeah.
We're almost a full point, if not a full point below that now, in just a matter of weeks, and that opens up like 2 to 5 million more borrowers, more home people that are able to purchase homes right now. So it's a pretty drastic difference. But when you open up with rates are high, I'm not going to buy right now, you need to understand what's going on in your local market and in the national market.
Yep.
And in the local market, Jerod, I want to ask you this question, not specific numbers, but how's our home inventory?
It is low, and for the foreseeable future, it will remain low.
Exactly.
Very, very low.
Yeah, historically low, right? So if you to kind of put some perspective around that topic a little bit, talking generational, right? So for all you younger generations out there, we're gonna talk about baby boomers a little bit here for a second. So baby boomers were the largest cross section of generation that this country had ever seen. Okay, well now we're seeing the millennials, the end of the millennials and the beginning of Gen Z come to that age where they start to buy homes.
Mm-hmm.
That cross section of residents in the United States right now is about 10 million stronger than the baby boomers ever were.
Mm-hmm.
Okay, so when you talk about supply and demand, you talk about inventory of current housing. The nation as a whole, we've never built that many residences before because we haven't needed to.
Mm-hmm. Yeah.
And so, yeah, anywhere from 5 to 10 years behind in supply here in our valley, I think is a projection.
Yeah.
So, go ahead, Jared.
Yeah, so let's talk about. I mean, supply and demand ratio. We won't spend a lot of time on. I think it's pretty clear to most that that is a thing to always consider. But I think it is important to back up a little bit. And you touched on the generations, right? Baby
Yeah,
boomers. My parents. Everything's relative, and the interest rates that they saw when they were in the in the bulk of their home buying, years were in the teens.
yeah,
So for them to hear that there's an 8% interest rate, for them that's not a super big deal other than the last couple of years, and they understand that that was a unique time. Whereas some of the younger generations, when they've seen rates in the twos, you get 5, 6, 7, 8, and it's a little jarring, it's a little disconcerting. But if you know that is right about where the historical average has been, it brings it into perspective. Like, this is probably where it belongs, or somewhere plus or minus a couple of percent.
yeah. Boy, there's so much that goes into that, right? Like the last 2 years with COVID and massive amounts of population moving to certain spots in the country, politically driven. All of that stuff goes into what we're talking about, and it's a lot of information, right?
Mm-hmm.
But I think generationally speaking, yes, the average was I think national or the historic average is about 7%.
Mm-hmm.
And I think my parents bought not their first home, but the home that we're in now, or not the home that I grew up in. Man, I'm mixing up my generations already. So the home that we grew up in, I think they were 13 or 14% on that. And yes, like homes are more expensive than they ever were. The cost of goods and services that we use are more expensive than they ever were. But as a nation, we're more wealthy than we've ever been too. We're making money in more different ways than we ever have before. Um,
And the wealth
so I
accumulation for those homes is much greater than it ever was then.
Oh, absolutely. And so, yeah, there's a lot of factors that go into that as a whole, economically speaking. But I think understanding that two was an anomaly, like that was created by the government or by the Fed or whoever you want to say that was they were held artificially low on purpose, um, for a purpose when we hit into COVID, right? And so you have to, anytime that you print money to the volume that we did, and artificially hold interest rates down. There's like the economy's you look at it as a living thing, right? Like there's always checks and balances. You can do one thing for so long, but you're gonna have to pay for that, right? It's that age old adage of for every action there's an equal and opposite reaction, and the economy is the same way. And anytime you interject too much, then there has to be a balancing of that, because too low of interest rates for too long it's hard to believe, but that's actually really bad too.
Yeah. Yeah, so we've talked about, everything's relative. This is historical average. You can enter the market or choose not to enter the market based upon how you feel. But the drum that we typically beat is you should absolutely figure out what your circumstances are, what your objectives are, and how we can best accomplish that for you. And it might be today, it might be a year or two. We don't know, but the sooner you communicate that and begin to delve into what that looks like and map it out, That's always the better case. Doesn't mean you have to pull the trigger today, move forward today, but to know where you're at sooner than later. I've never seen a case where that isn't the most beneficial. So let's chat about what the next year or two could potentially bring in the way of why you would potentially want to buy today. And we've touched on this a little bit on prior podcasts, but for those that say I'm gonna wait till they come down, why would that potentially not be in their, where would it potentially go to, and why would it potentially not be in their best interest to wait?
Yeah, so like I'm not going to mince my words here. Like I'm adamant about the fact that if you can buy now, I personally, and this is my personal, like don't put this on anybody else. And there's a chance that I could be wrong, right? I thought rates would be lower by now, based on the information that we had at the time, and that didn't happen, right? But I will say, looking at all the factors and breaking it down to the basics of supply and demand, if we have an enormous amount of demand for homes in this valley. Am I correct, Jerod?
Pent up demand, people looking at the market, just waiting. Yeah. So fast forward, what does that look like once the rates do come down a little bit and they all jump on?
And that's the thing. And I've been like, you talk about beating a drum. I've been screaming from the rooftops for a year plus now about this. And now you're starting to see a lot of people talk about it. But if rates start to come down, so we were behind, right? We were behind in supply. I mean, there's so much history here, but you go back to '08, right? And the crash that was actually driven by real estate. You go back to '08, in 12, things started to come back and people started to buy homes again. And there's like a full decade where builders didn't build across the nation, right? Not anywhere near enough, and very, very minimal. We start to come back, economy's looking strong, housing market's looking strong, COVID hits. Okay. So everybody kind of stutters and stalls, right? Because they don't know what's going to happen. It's the first time we've ever been told to stay home. And now builders take off again because the market takes off again. And then we hit, the slowdown. Interest rates start to climb, which they had to at some point, right? Once they've been in the two.
Sure. Can't
so
stay there.
Yeah, they can't. And it was artificial to begin with. And so now the builders have slowed down considerably again. And we never got caught up with supply in the first place. So now we're deepening that hole and that fracture between supply and demand. And so, and for Idaho, if we have, people watching from across the nation, I think everybody's behind in supply. For some of the states, and I like to call it the great political migration. We're experiencing a lot of people moving here from California, Oregon, Washington, and I know Texas is as well, and so is Arizona. Like they're there. I still talk to people all the time that want to be here, and they're just kind of waiting in the wings. So the minute rates start to drop, that market's going to open up. Everybody's going to come back in, and now you have to worry about that first year of COVID, right? That first year of COVID when people were offering $20,000, $50,000, $100,000 over asking price. And there weren't enough homes. And so it's like 10 plus offers, right? Like, was there a house sold in a 2-year period, Jerod, without multiple offers in this valley?
I don't think so. If there were, it was few and far between.
Right. And so now you're talking about a massive, because when they offer over and they close, now you get enough of those that do that, you're resetting that market value.
Yep. Correct.
Right. And so now you're talking about massive appreciation again.
Yeah.
And so paying more per month for 6 to 12 months, I think is a much less of a problem if you can afford it, than paying $50,000 to $100,000 more for the same house in the matter of 12 months.
Yeah, so let's talk about what that would look like. So you buy a house today, let's just round number 8% where we're at, and you're at today's current values, which have corrected in the valley here, probably on an average of like maybe 100K, valley wide. So now you've come off of that high where everybody was throwing briefcases of cash at homes. You've come back to where we need to be. You purchase a home at 8% because we don't want it to go back up, right? Demand comes on, supply is low, prices start going up again, of which you're not going to correct, right? But you can correct the interest rate at which you're paying for on that mortgage. So talk them through what that would look like. Buy at 8 today, at today's pricing a year or two down the road?
Oh my goodness. So there's so many numbers that go into that, right? And so many determining factors like credit score and everything like that. But just in generalizations, like if you're, I don't know, a 370 purchase today, mid to low sevens, you're probably, depending on whether you have down payment assistance or not, you're probably looking at a monthly payment of, I don't know, I'd say anywhere from 28 to 31 a month on a 370 house, right? So
Okay.
that's our first time home buyers in this valley, right? So it's a
Mm-hmm.
considerable payment.
Mm-hmm.
And that's, if you're using down payment assistance, or there's a lot of variables that is why I'm giving that range.
Mm-hmm.
So that interest rate drops, a full percentage point on that amount. And, feasibly you could be, again, depending on what you have involved there, but you could be, $200, $300, $400 a month less in payment once you can adjust that, right? So those are kind of the numbers, and it's very loose. We'd have to run, your specific scenario, right, or each person's specific scenario, so we can get you the real numbers. But the alternative is $50,000 in equity, right? Like one of the adages I like to use is, do you want to have $50,000 in your savings account, or do you want to pay $50,000 more for the house? Right, because
Easy
that's
answer.
what a house is, right? It's for savings, right? Like
Yeah.
equity isn't realized until you refinance or you sell, but it's still building wealth. It's still money that you're accruing over that time period. And so, I mean, to your point, Jerod, earlier when so many people are offering and at above market value, like how long does it take to start to gain equity in a house that you've paid that much more for? Like,
Oh, right. If you overpaid intentionally.
yeah, yeah. I mean, now you're behind the eight ball. You may be 2 or 3 years before you actually get to even, and then start to gain equity on that property, as opposed to buying now with a little bit of, with a higher payment, but buying right, buying with seller credits, buying when you don't have competition, buying when you're in the driver's seat more. I think it's
Yeah,
just financially in wealth building in mind, that's just the way to go.
yeah, and that's a good point. So if you buy a home today, our prior podcast was the promotions, the seller concessions that are published, marketed to the public from a new construction builder that we can even get on the reseller, the existing home market. So now your values are corrected; they're where they should be. Now you've got a promotion that is given to you in the way of paid closing costs, rate buy down, all the other things that we talked about it being contributed to that you're not going to get when the market strengthens up again. So adjusted value, credit or promo, maybe a rate buy down, like all of those things together could be very powerful. And even if you did get a slightly higher rate than you'd ultimately like to be, that is something that can be corrected as rates adjust down.
Hmm.
So
Absolutely.
if we're going to capture everything we're talking about today is, there are reasons why somebody would want to move forward with buying on a home purchase now, specifically being a good time, as opposed to our initial take, which was, oh, I'm going to wait because it's 8%. We've totally flipped it for some on its head to say, I'm going to hold off to, wow, you should absolutely be looking now because your timing could be very good for your scenario.
Yeah, just, I mean, in the simplest form, and it's not easy because there's interest and everything else involved, right? But in the simplest form, if you look at, so say the interest rates come down and the number's got a five in front of it, and that's what a lot of the experts are saying. I don't know that it has to get into the fives to get really busy again. I think solidly into the six, we're going to see a bunch more activity. But so say the number has a five in it, and you can save, you know, in the extreme $400 a month in payment by, in interest rate difference. If you paid $25,000 more for that house, right, that's 62 months. So if you buy now with a higher rate, right, you're paying $400 a month more, say, for that house. as opposed to, for 6 to 12 months versus 8 to 12 months from now, you buy it $25,000 more expensive for the same house, right? That's you could pay that higher monthly rate for 62 and a half months
Mm.
before you'd get to that $25,000 extra that you'd be
Mm-hmm.
paying. And
Yeah.
now you're probably upside down in equity a little bit for the next 6 months to a year.
Yeah. Yeah. And I think a lot of this is some of the carryover from what you alluded to earlier, and that's the mortgage meltdown. The
Mhm.
perception is market tanked then. I'm going to wait for it to tank again. What people need to take into account is that was a super unique circumstance, just like COVID was, right?
Mhm.
That was a perfect storm of a lot of things that, to my knowledge, really the Depression was the only time where real estate values, um, uh, de- devalued to the point where they did in '08, '09. But the likelihood of that perfect storm or a similar perfect storm uh, existing again is little to none, in part by what has just happened, what we just talked about. For the homeowners that are in a 2% or a 3% interest rate on their mortgage, they're likely not going anywhere unless they absolutely need to. Why would you trade a 2 or a 3 for a 7 or an 8?
Well, well, and that further deepens the supply problem, right? So if
Yeah.
if if it's me, and I have a home that's in the low threes or the high twos, um, and I want a new home, chances are I'm keeping that other one for investment property,
Yeah.
right? So even the people that are going to leave, a lot of them, or a certain percentage of them, I guarantee you are going to keep those homes for investment properties because they're going to cash flow well,
Yep.
right? Because homes have appreciated since then, rents have gone up, and they have a low interest rate.
Yeah.
That great recipe for an investment property.
Yeah, and that's where I was going with that is the appreciation that was realized in that time. Not only were my rates low, but it appreciated to a level where I'm going to fight tooth and nail to keep that home. In '08,
Mm-hmm.
'09, I let that home go because I was upside down.
Yeah.
We're not going to have the people that are upside down. We're not going to have the homes that go back on the market to create inventory. So in '08, '09 was special circumstances. A lot of what they called shadow inventory or whatever inventory that kept flooding the market. We're the opposite. Not only were we not creating inventory through new construction, but we're holding inventory tight because of the interest rate that we have and the appreciation value we have. Those homes aren't likely to come back. So anyway, my point is to reflect back on and expect the same outcome and hopefully benefit from a reduction in home prices today because of what happened 15, 17 years ago.
Mm-hmm.
It's just an unrealistic expectation.
Yeah.
And as we always say, hope is not a strategy. To hope they're going to go down. Yes, they've corrected, as I mentioned earlier, and that was an adjustment that needed to be had because people were overpaying. We've settled that, and that issue's pretty much gone. But I think we're much more back to the high demand, low supply, which is going to increase values. Exactly full circle to your point.
Yeah, and I mean, yeah, '08 was definitely an anomaly. It doesn't mean we can't have other anomalies, but we're not built for that right now, right? The real estate market drove that, and overinflation and over speculation, and a number of different, they've corrected the lending and the appraisal issues that helped to drive that, so it's not likely. So here's the thing, like there's a ton of things going on in the world, right? We've got Ukraine, we've got what's going on in Israel now,
Israel.
and there is no way to project exactly what's going to happen, right? We can look at the numbers and we can make the best decisions to move forward that we can. I promise, if you live in fear and sit on the sidelines in every aspect of your life like that, like a lot of people do with real estate, you're not going to get ahead, right? So, yeah, you can wait for you can wait for the sky to fall, or you can go out there and make miracles happen.
Yeah, yeah. There you go. It's a lot with the lens that you come at your objectives and goals with, right? So just to kind of summarize, everything's relative. this is where the market's at. Depends on how you look at it. But the one thing that we know is we'll definitely look at your objectives, your goals, help you assess the best plan going forward. Your best interest is our objective. And the likelihood of getting into something like a temporary rate buy down or rate buy down in today's market through the sellers, whether it's new construction builder or whether it's an existing home, we can ask that of them now, which will help you either buy your rate down permanently, move forward, or do something temporary until rates do come down. But you've already qualified at the higher rate, so now you've kind of taken advantage of a short-term situation for a good long-term outcome. So,
absolutely.
Anyway,
that's the plan, and I'm sticking to it, man.
yeah. But reach out to us, and get that free, no obligation consultation that we have in our home buying process to just understand where you're at, what the implications are of moving in one direction or another. We'll, shoot it to you straight. We work off of repeat and referral business, so we have to far exceed our clients' expectations to do that, and we want you to be part of the family, and we want to be close friends, over the years. And of course, we have to do, the best that we can for your efforts. So reach out to us at either one of our websites. For Chase's website at summitfunding.net, Chase's contact information, just reference the perfect home buying process, and we'll get you started on that program, get you introduced to those offers. And you can go to myhomeconnection.com. The phone number and email contact information, make that same reference to the perfect home buying process, and we'd love to help you out, at least answer any questions you might have or put your mind at ease about whatever it is you're looking to do. So with that, Chase, man, we really appreciate you coming on the show and sharing your perspective on the financing side, and we look forward to working with clients going forward.
Yeah. Thanks for having me again, Jerod. Sorry if I monopolized. I got up on my soapbox there for a minute today. So
it was about interest rates. So that's
appreciate you indulging me.
Sure, no problem. All right, Chase. Well, with that, again, thank you for your time today, and we'll wish everybody a blessed one.
Take care.